Edge designations, CFA Level 1, pre-reading, financial statement analysis, learning module 8, non-current or long-term liabilities. And this is a fairly short learning module. There we go. And only has got 3 learning outcome statements. Keep in mind, again, we're going to see this. It's going to repeat itself again. Remember where we are. We are in the pre-reading section. Of course, this will come out again, okay, when we then cover the core, in the core material, when we cover non-current liabilities. On to page number 2, learning module 8, non-current long-term liabilities. And when we talk about long-term liabilities, we talk about initial recognition, initial measurement, and subsequent measurement. We're referring specifically to bonds. And just by way of introduction, people often get confused with bonds. And if I just take you down over here, remember we're in the long-term liability section. Okay, and if I had to say to you, let's have a quick look, what kind of a bond are we talking about? And remember, okay, there's always going to be what we call the person that sits over there. That's called the issuer of the bond. He issues a bond, and over here is we've got the investor. The issuer of the bond is also, that's the company that we're dealing with now. He issues a bond. Now when he issues a bond, okay, what happens? Okay, the investor invests in the bond. Okay, and let's say it's a $1 million bond. So $1 million is then given by the investor. Look at the cash flows, by the investor to the issuer. The issuer now in his books, look at the entry that he's going to put in his books. He's going to say debit his bank account because he receives $1 million. Credit what? Long-term liabilities, because he's got to pay that amount back then to the investor. Okay, how does he pay it back to the investor? What do we know with normal bonds? Okay, the issuer pays back to the investor both what we call coupon interest, and then he pays back the principal as well. But can you see the flow of it? So the investor gives money to the issuer, and what's interesting, across our CFA level 1 syllabus, we'll deal with both of them. The issuer of the bond, remember the issuer of the bond, he issues the bond, he gets the cash up front. For him it is what, guys? Okay, it is a liability. He owes that back. How does he pay it back? Via coupon interest and principal on a regular basis. Okay. Looking at it from the investor's point of view, he's invested in someone else. Why did he give you the $1 million? Because what's he going to get? It's hopefully a nice, safe, secure investment, and he'll get back coupon interest and principal. From his point of view, it's an asset. Okay, he invested in an asset. On the liability side, where do we see that, guys? Well, we're going to see that over here, guys, in the FSA section, financial statement analysis section. In an asset section, we're going to see it in the fixed income section. Remember, in CFA level 1, we deal with 4 asset classes: equities, fixed income, derivatives, and alts, alternative investments. This one falls under the asset class fixed income. Okay, why fixed income? Because you can see its nature over there. Okay, now that we've got that out of the way, okay, we'll talk a little bit about a fixed income security. We talk about its maturity. Maturity is the number of years left on the bond until the final principal payment is due. Could be 1 year, 2 years, 5 years, 10 years. Each one will be different. A short-term bond, normally 1 to 5 years. An intermediate-term bond is 5 to 12, and a longer-term bond is more than 12 years. Okay, good. Who cares about maturity? Why is that important? Term to maturity is how long the bondholder, his name, I'm going to put his name here also. His name is investor, or you can also call him bondholder, either one. Okay, the investor or the bond holder will get interest, coupon interest and principal. The yield offered on the bond will depend on its maturity, and the price of the bond will change over its life as it responds to market interest rates, to yields in the market. Okay, we talk about a par value bond. A par value bond is the amount that the issuer agrees to pay at the maturity date. Okay, the amount is the principal value, face value, redemption value, maturity value. It's all got exactly the same. It's all different names for exactly the same thing. Okay, the coupon rate, this is important when we talk about bonds, guys. The coupon rate is the amount that the bond holder is going to receive from the issuer. Okay, we have a look at this particular example over here. Okay, there's a bond for you. Okay, the 6 in the front indicates its coupon rate, and it's $1,000 par value. Par value, every bond has got two components to it. This is important to understand. It's got the price of the bond, okay, and it's also got its final value. Okay, we also call that the par value, the end value. Okay, what is the price? The price is the amount that the investor will pay. In other words, he wants to invest in this particular amount of debt. How much will he have to pay for it? Okay, the par value is the amount that the issuer repays at maturity. Sometimes they're the same amount. If the price, let's just say for example, I'll give you 3 examples over here. If the price that the investor pays is $1,000, the amount that the issuer will repay at maturity is also $1,000. That's called a par value bond. Okay. If the investor is prepared to pay $1,000, okay, and for a par value bond, in fact, I want to just change that and make it look a bit easier. I'm going to keep the par value at $1,000 for all my examples. Okay, and then we'll go over here for the last one, and also make it a par value then of $1,000. Now let's go back. For this $1,000, the investor pays $900. That's called a discount bond. Why is it a discount bond? Because he's paying $900, and in the end of the day, how much will he get back? $1,000. What if the investor is prepared to pay $1,100? That's the price to get back $1,000 at the end. That would be called a premium bond. He's paying more to get back only the $1,000. And of course you ask yourselves, why will all of this be? Well, it'll depend on what the yield is. Everything gets driven by the yield. 2 more points I just want to mention before we move on. Okay, number 1, okay, price, the word for price, because that's the amount that the investor pays when, now, is also called, it's also a proxy for present value. So if you're ever trying to calculate the price of a bond, okay, remember that's the amount that the investor will pay up front. Okay, that's called present value. The par value is that the amount that the issuer repays at the end. That's called future value. So you can see now that you could do a lot of these calculations on your calculators because it's just present value, future value calculations. The last point before we carry on, okay, is that in our example over here, the 6% coupon rate, it's important to remember 2 things about the coupon rate. If it is a fixed rate bond or fixed rate note, okay, what's important to remember is that the coupon rate never changes. Okay, so it'll be 6% for its entire life. The life might be 5 years, 10 years, doesn't make any difference. The coupon rate will remain the same then. Okay, important point then in number 2 is how much does the issuer pay the investor, let's say on an annual basis. It's always going to be par value. In other words, that value there, the amount that gets repaid at maturity, the $1,000 in my case over there, multiplied by the coupon rate. And that's why you can see in this example, guys, how much is the amount of coupon per year? It's $1,000. That's the par value, redemption value, future value times 6%, which is the coupon rate, giving you $60 per annum. Okay. Let's have a look over here. Where do bonds sit on the balance sheet? Remember, guys, bonds, and I'm looking at this bond from whose point of view? From the point of view of the issuer. So from the point of the view of the issuer, it sits on his number as a balance sheet liability. How much? It comes on at what? The present value of all the cash flows discounted at what? The market interest rate. How would you calculate that? Believe it or not, it's just the present value calc. So you say to yourself, okay, what are all the cash flows from the particular bond? Find yourself an appropriate discount rate. That is equal to present value. Present value is equal to price, and that's the amount that the issuer, okay, or the company will receive. Okay. What about the income statement? What's the impact of bonds then on the income statement? The interest expense in the income statement is what? The balance sheet liability times the market interest rate. But what do you notice now? And this is important, of course, guys, okay, that for the income statement, okay, amount, it's the amount per the balance sheet, okay, not the par value, and it's times by the market rate. How do we compare that to the coupon? I've changed colors over here. When I'm calculating not the interest expense in the income statement, but the coupon, in other words, the amount that actually has to be paid, it's based upon what? Not the balance sheet liability, but based upon the par value of the bond times by the coupon rate. Coupon rate never changes. Okay. The market rate always changes, because remember, interest rates in the market always move around. So can you see there's a complete different way of how we handle this, guys? Can everyone see that? So in terms of when I'm paying the amount I've got to pay, called the coupon, it's par value times coupon. But when I'm looking at how much I record in my income statement, I say it's my balance sheet liability times the market rate, the market yield. Okay, and we've spoken about these already, bonds issued at par, premium, and discount. Okay, I'm not going to spend too much more time over there. And how we treat them then in the balance sheet, we've spoken about that as well. Okay, down the page. Okay, what about the only one that we haven't spoken about to any extent then is going to be the how we treat it in the cash flow statement. Doesn't matter when the bond is issued. And remember, guys, when the bond is issued, what happens? Now remember the flow. The flow was what? There is the issuer, there is the investor. The investor pays money to the issuer. The issuer then records it on his books as A, where he receives the asset from the investor called cash, or bank. And then what does he do? But he owes that back to the investor, doesn't he? There's a liability. Okay, and that's what, of course, over here you can see when you look at the balance sheet. There is your debit bond, credit, debit cash, credit bond. No matter what type of bond it is, we've always got to record that we have received cash, but there's a liability that needs to be repaid over time. On the cash flow statement, when the bond's issued, we say that's a cash inflow. Cash inflow, cash inflow. Doesn't matter if it's a par value bond, a discount bond, or a premium bond. When coupon is paid, that's a cash outflow. Now remember, we spoke about this earlier when we looked at the cash flow statement. Okay, when interest is paid, US GAAP says cash flow from operations. IFRS says what? You can either treat it as a cash outflow from operations or cash flow from financing. But again, it doesn't matter what type of bond it is, the impact of it and the treatment in the financials is the same. When the bond is redeemed, in other words, at the end of the day, when the principal is repaid by who? By the issuer to the investor or to the bondholder. It's a cash outflow from financing activities, CFF. This particular section, treatment on the cash flow statement, must be read in conjunction with the notes then on the cash flows. Okay. How do we've gone through the theoretical treatment of everything. Okay. Let us now have a look, guys, then at the particular items over here. In terms of the method that we use, the method itself that we use to do all of our accounting is called the effective interest rate method. Okay, and remember, okay, the coupon payment made to the investor does not equal the interest expense. We've seen that already. I'm going to take you back a page. I want to show you that again. So in terms of the income statement, remember that, guys, the interest expense does not equal the coupon. There are two completely different calculations, so important that we remember them. One of them is based on what I'm actually going to pay, and the other one is based then on the market rates in the market. Okay, cover page 5. The interest expense, and we've spoken about this already, is the value of the liability at the beginning times by the market yield. Let's just do a quick revision. What would it be? What's my coupon? And you can even see the terms are different. It's coupon paid. Coupon paid is equal to the par value of the bond times by the coupon rate. Coupon rate never changes. The bond's yield always changes because it's based upon market rates. Okay. The cash flow statement, we've spoken a little bit about this, and I want to hop straight now, guys, then into looking at a little bit of an example. Okay, let's have a look over here at a premium bond. Okay, now remember, what did we say a premium bond is? A premium bond is that the amount that I pay for it, the price of the bond. Price of bond is also equal to present value is at a premium. Premium to what? Premium to its par value. Its par value is also equal to future value. Everyone comfortable? Well, let's have a look over here. The term of the bond is, let's have a look. Okay, it's a 3-year bond. It pays a coupon of 8%. The par value, face value, maturity value, redemption value, future value. Can you see how many names it's got? Okay, is equal to 10 million. What does that mean? That means at the end of the life of the bond, it will pay out an amount then of $10 million. By who? By the bond issuer to the bond holder or investor. The market interest rates at this point in time are 7%. Now you can see why, by the way, it's called a premium bond, because look over here. What are the interest rates in the market at the moment when we issued the bond? 7%. Why will this particular issuer be prepared to pay coupon more, which is 8% more than the market is paying? Why would he pay more? Well, because he's getting more money up front. It's a premium bond. He's receiving more than the 10 million. And because he receives more than the 10 million, he's happy, so he's prepared to pay a higher coupon than the market interest rate. Okay, good. But we don't know how much more. Let's go and work out how much more. Let's go into the calculations then. Okay, step number 1. Okay, we need to calculate the price of the bond. What's the price of the bond? That's its present value. Okay, so we've got all my inputs to do this into the calculator. Let's put everything in one by one. Future value minus 10 million. Payment minus 800,000. Why minus 800,000? Okay, because remember, for the payment is equal to the coupon. What's the coupon? The coupon is always par value of $10 million. I got that from here, times the amount of the coupon, 8%. There's my 800,000. Is everybody happy with that? Okay, period 3. Interest rate. Whenever I put interest rate into my calculator, I always use the market rate, or what we call the yield. Okay, and that's 7%. put that into your calculator, and what does that give me, guys? That gives me present value. What's another word for present value? Price of the bond. What is it? What also is that? That is the amount of the proceeds. In other words, that's how much, if you wanted to buy a bond with all of these details attached to it, you would need to pay $10.2 million for that. Okay. And you can see now, you can see why it's called a premium bond, because you're paying $10.2 million, okay, upfront for a bond that has a par value of $10 million. Everybody comfortable with that? Let's go and see the treatment over here. Okay. And work with me on these calculations. Now, I want to just pull certain numbers through. Let's just go back. So go back a page. I want to pull a number through over here, and that is the market rate of 7%. Okay, now we can show you everything. Okay, so we know, guys, that the market rate or the yield is equal to 7%. So is everybody comfortable? When I first took, and we're always looking at it from whose point of view, because we are in the liability section, we're looking at it from the issuer's point of view. It is a liability in his books. Everybody comfortable? Okay. Year number one, when I brought that liability on, it was 10262. Previous page. Let me just show you where we got that. We got that by calculating that as its present value, 10262,432. Okay. Coupon doesn't change, guys. Remember what we said? Coupon 800, 800, 800. How do we calculate the coupon, guys? You remember par value of 10 million. Okay, there's its par value. Remember, par value's got many different names. Times the coupon rate of 8%, 800,000. That'll never ever change, and that's why the coupon stays there. Okay, but let's look at the interest expense. The interest expense, let's work it out. The interest expense is what? So remember what we said. It's always opening value, so it'll be 10,262, 432 times, what's the market rate? Remember, we use the market rate, not the coupon, times 7%. Let's just run that into the calculator over here. So it's 10,262, 432 times 7%. I get 718. Okay, 718, 370. Everybody comfortable with that? Okay, and there's the interest expense. What's the difference between the interest expense that of course goes through the income statement and the coupon, the amount that I pay? Well, the difference is clear. It's 81,630. What does that difference do? Look at that. That difference takes the opening book value from 10,262 and takes it down to 10,180. Okay. That 10,180 gets carried forward to the next period. Can you see then what happens? What's my interest expense in period 2? It's going to be 10,180, 802. We're assuming that the market rate hasn't changed. It might well, but okay. And that's equal to 712,656. That amount. What's the difference then in year 2 between the interest expense of 712 and the coupon, which never changes? That difference is 87,344, bringing my closing book value down to 10,093. 10,093 gets carried forward to year 3. Calculate my interest expense based on the green number over here, 10,093. What's the difference between those two amounts, guys? That is the amortized amount over the period. Lo and behold, what is the closing book value of the debt? It always goes, no matter what you do, guys, it's always going to go back to its par value. No matter if it's a par value bond, a discount bond, or a premium bond. Okay. The next bond over here, I'm not going to spend time on it. I'm just going to describe it to you. It's called a discount bond. Okay. And again, all the numbers are here for you. The only thing that we've changed over here is we've taken the coupon being 8 and we've changed the market yield, which we had before being 7%. We've now made it 9. Can you see why it's a discount bond? Why is it a discount bond? Because the market should pay how much? Per the market, how much should the Bondholder receive 9%. How much is he going to receive? Only 8. Why would a bondholder stroke investor agree to receive a little bit less? And the reason is because he's going to pay less. How much less? Well, let's do the calculations. I'm boring you now. Future value, $10 million. That's the par value. Payment hasn't changed at 800,000. 3 years and the interest rate of 10. Compute present value or price, and I get to amount of 9746871. What is that? That's of course less than the par value of 10 million, hence a discount bond. And what do you notice? Now the difference between interest expense and coupon as to the amount. What's the value at the end of the life? Same 10 million. Okay, there we go. And there's a par value bond. I'm not spending time on a par value bond. Those are nice and easy over there. Okay, and there is all of your details for you. There's a nice little summary for you. Interest expense, okay, we know. Okay, liability value, we know. Cash flow, we've discussed. And then where everything goes. A little table for you there just to see everything, but we've discussed everything up to this point. Zero coupon bonds. What's a zero coupon bond? A zero coupon bond is a bond with exactly that. A zero coupon, no coupon at all. It does not make any interest payments. It only makes a final payment at the end. Okay, it's called a zero coupon bond. Issuance costs. What about the various costs that are involved in issuing of a bond? Sales commissions, pricing, all the printing costs, legal costs, advisory fees, things like that. Okay, per US GAAP. Okay, these are capitalized as an asset and get allocated to the income statement. Per IFRS, the costs are deducted from the bond amount on the balance sheet. There we go. Fair value reporting option. The fair value of the bond liability will remain the same as long as the yield in the market doesn't change. But of course we know, guys, that market yields change very often. And what do we know? And we're going to see this much more when we get to the fixed income section. As market rates, as interest rates go up, bond prices fall, and vice versa. As interest rates in the market go down, bond prices rise. Okay. What about derecognition of debt? This is the last little bit. Derecognition of debt. In other words, when the debt has been already recognized. How do I get rid of it? Well, I redeem the bond at maturity. How do I redeem the bond? I pay off the full amount that is owing on the bond, the principal amount. Okay. What if I redeem the bond prior to maturity? Well, again, I have to say to myself, how much did I end up paying? The redemption price. What did I manage to redeem or extinguish my liability at? Less what was it in my balance sheet or my carrying value on my books at that point in time. It'll either be a gain then or a loss. In terms of the US GAAP, any unamortized bond costs need to be written off first. Not applicable to IFRS because we said before they are all accounted for up front. That then brings us to a conclusion of Learning Module 8, non-current liabilities. On page 9, I've got a little bit of a summary for you over there. And as per usual, guys, we go back to the beginning of the particular learning module and just take a look, guys, again then at the learning outcome statements and make sure you are familiar with those and are able to give a little bit on each of those learning outcomes. Then we know that you have taken them in and understood them. Next learning module coming up.